Over the last 18 years, Mohnish Pabrai, sometimes known as the Indian Warren Buffett, has averaged a 25.7% yearly return. According to Forbes, he has no interest in a firm that appears to be 10% undervalued. In a few years, he hopes to make 5 times his money. And if he doesn't believe the opportunity is evident, he will pass. And this technique is currently working for him. Between 2000 and 2018, his assets has increased by almost 900%, putting him in charge of more than $600 million. So how did he manage to pull this off? How did he outperform most investors who were lucky to obtain a 10% yearly return, much alone 25%? In today's video, I will teach you a few ideas that can help you attain these objectives by providing sticks too. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my best greetings. And to be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. And if you're ready, let's get to the video. Now bear in mind that following these steps will not guarantee you the same returns as he did, but they will most likely assist you in improving your investment so that you may perhaps achieve greater outcomes.
The simplest way to find bargains is to be a cloner. And I am what you would call a shameless cloner. And then in the US, we have 13F filings where every quarter people have to file what they own. So just figure out who the smart people are, look at what they're buying, reverse engineer them. You don't need an analyst. It's actually fun.
This is a highly sensible and clear niche technique, but very few people use it, since most well-known investors is legally compelled to disclose what stocks they've purchased in every quarter using a document known as the 13F filing. Mohnish's techniques is to select an investor with a track record of good returns and whom he trusts, and then just imitate their investments. So how do you go about doing it? Well, with the internet, it is pretty simple in today's world. Google Datorama, and then click on the Super Investors link. It is that simple. Here are some of the most successful investors who are legally required to reveal their holdings. As a result, we can simply go to someone like Bill Gates, for example. He has his primary holdings, and these are the equities he has just purchased. If you are into Bill Gates as an investor, look at the equities he has purchased, study them, and then determine if they are worth investing in.
Say it's a moat, and they'd break it down to one word. But basically, it's the ability of a business to have some type of an enduring competitive advantage that allows it to earn a better than average rate of return over an extended period of time. So some businesses have narrow moats, some have broad moats, some have moats that are deep but get filled up pretty quickly. So what you want is a business that has a deep moat with lots of piranha in it, and that's getting deeper by the day.
There is a moat. I'm sure most of you are aware that it is the water that surrounds a castle and is employed as a kind of defense. The moat is commonly used as an example for a corporation with a significant competitive edge when it comes to investing. Even if additional competitors try to grab a piece of their business, the moat is so large that there are so many piranhas in it that competitors will find it impossible to attack what they've built. Facebook is an example. Because Facebook's user base is so large, it is difficult for a competitor to come in and just mimic it. Because people like their products, Reese's Peanut Butter Cups, or Ben & Jerry's is extremely difficult to duplicate. So, before you buy a stock, check to see if it has a powerful moat.
So, summing up in terms of what do you think do you bring to value investing that others perhaps don't, that give you a unique edge?
I think the biggest edge would be attitude. Charlie Munger likes to say that you don't make money when you buy stocks, and you don't make money when you sell stocks. You make money by waiting. And so the single biggest advantage a value investor has is not IQ, it's patience and waiting for the right pitch, and waiting for many years for the right pitch.
So what's that saying of Pascal that you like about just sitting in the room?
All man's miseries stem from his inability to sit in a room alone and do nothing. And all I'd like to do to adapt Pascal is all investment managers' miseries stem from their inability to sit alone in a room and do nothing.
You also don't engage in things like short selling.
Why would you want to take a bet, Steve, where your maximum upside is a double and your maximum downside is bankruptcy? It never made any sense to me, so why go there? That's right. I think the low risk, high uncertainty is really something I borrowed from entrepreneurs and the Patels in India or the Richard Bransons of the world. Basically, if you study entrepreneurs, there is a misnomer. People think that entrepreneurs take risk and they get rewarded because they take risk. In reality, entrepreneurs do everything they can to minimize risk. They are not interested in taking risk. They want free lunches, and they go after free lunches. And so if you study any number of entrepreneurs, from Ray Kroc to Herb Schultz at Starbucks, and to even Buffett and Munger and so on, what you'll find is that they have repeatedly made bets which are low risk bets, which have high return possibilities. So they're not going high risk, high return. They're going low risk, high return. When I'm looking at an investment, I now look at it like the way I looked at my first business, which is the first thing I'm looking at is how can I lose money on this? And can I absolutely minimize my downside? The upsides will take care of themselves. It's the downsides that one needs to worry about, which is why even the checklist becomes important. But so the important thing that value investors focus on is downside protection. And that's exactly what entrepreneurs focus on, is what is my downside. So that is I would say the crossover between entrepreneurship and investing, and value investing especially, is protect your downside. Yeah, so the checklist I have currently has about 80 items on it. And even though 80 sounds like a lot, it doesn't take a long time. It takes about 30 minutes to go through the checklist. What I do is when I'm studying a business, I go through my normal process of analyzing the business. When I'm fully done and I'm ready to pull the trigger, that's when I take the business to the checklist. And I run it against the 80 items. And what happens the first time when I run it is there might be 7 or 8 questions that I don't know the answer to, which is great. What that means is, listen, dummy, go find out the answer to the 8 questions first. So which means I have more work to do. So I go off again to find those answers. When I have those answers, I come back and run the checklist again. And any business that I look at is going to have some items on which the checklist raises red flags. But the good news is that you're looking in front of you with all your facilities at the range of things that could possibly cause a problem. And when you look at that list, you can also compare it to how those factors correlate with the rest of your portfolio. And at that point, you have a go, no-go point where you can say, I'm comfortable with these risk factors here. I'm comfortable with the prior probabilities, and I'll go ahead with it.
Can you give a couple of the things that are on your 80 items?
Oh yeah, sure. There's the checklist was created looking at my mistakes and other investors' mistakes. So, for example, there's questions like, can this business be decimated by low-cost competition from China or other low-cost countries? That's a checklist question. Another question is this a win-win business for the entire ecosystem? So, for example, if there's some company doing, high-interest credit cards and they make a lot of money, that's not exactly, helping society. So you might pass on that. Or if it's a liquor company or tobacco company, those can be great businesses. But in my book, I would just pass on those, or a gambling business and so on. So the checklist will kind of focus you more towards playing center court rather than going to the edge of the court. And there's a whole set of questions on leverage. For example, how much leverage? What are the covenants? Is it recourse or non-recourse? There's a whole bunch of questions on management comp, on the interests of management, on just a whole on their historical track records and so on. So there's a questions on unions, on collective bargaining. And all of these questions were not questions I created out of the blue. What I did is I looked at businesses where people had lost money. I looked at Dexter Shoes, where Warren Buffett lost money, and he lost it to low-cost Chinese competition. So that led to the question. And I looked at Court Furniture, which was a Charlie Munger investment. And that was an investment made at the peak of the dot-com boom, where they were doing a lot of office furniture rentals. And the question was, are you looking at normalized earnings, or are you looking at boom earnings? And so that question came from there. So the checklist questions, I think, are very robust because they're based on real-world arrows people have taken in the back.
Mohnish believes himself to be a slacker investor. He refers to it as a gentleman's activity, which must originate from a point of leisure. This is intriguing because practically every investment course emphasizes hard on labor, frequent stock analysis, and daily listenings to CNBC. And Mohnish says otherwise. You are not obligated to invest in this manner. Follow simple fundamentals produced by some of the ultimate investors of all the time, such as Warren Buffett and Benjamin Graham, and then you can get some extremely high returns. The secret is to be patient and just commit to these fundamentals. And with that, today's video comes to a close. To express your love and support for the video, click the like button below if you haven't already. Also, don't forget to subscribe to our channel by clicking the subscribe button below. Also, click the notification bell next to it to be the first to know when we have a new video. Thank you for taking the time to watch, and we hope you enjoyed it. We look forward to seeing you in a future episode.